All right. Well, welcome back. Actually, we should be playing the tune to "Welcome Back, Cotter." Only this is "Welcome Back" podcast, folks. Chris is here. I'm here. We're welcome you back to. We haven't done this in years. The Power Profit podcast.
It's been a dog's age, or it's been a hot minute, as they say, right, Tom?
It has. It has. You look the same. When did we do this last? Was it 2019?
I think maybe we saw 2020. I think we were actually actively, maybe even a little bit into 2021, but I can remember the summer of 2020 doing one on the road with you. So it's been a couple years. Yeah.
Yeah. So, folks, our plan here with these podcasts is we're not doing this isn't day trading. This
Mm.
isn't short term call buying, put buying, spread buying. We're not going to get any multi leg strategies. We want to really kind of lay the groundwork for you. All right. If you want some of the more detailed stuff, I have it. Chris has it. You know where to go to find this information. This is really more of a 40,000-foot view of how both Chris and I take a look at the markets, take a look at the world, and try to digest what news stories are out there that could definitely add some X's and less O's to the scoreboard that we like to call our portfolio.
Yeah, exactly, Tom. I think it's funny. You mentioned no short-term trading, or we're not going to talk about that. The buzz about 0 day to expiration and all of these things that we saw drive 2022 and the excitement there, they seem to be buzzing off, and I'm glad. I'm happy for that. It's time to take a look at this market for longer-term trends, and that's what we're here to
It
do.
is.
Yeah.
And in long-term trends, like I said, we're not day trading. We don't trade on hope. We don't trade on fear. We don't trade on greed. We're not into the emotional type of trading. If you're an emotional trader, you're in the wrong place. All right.
Yeah.
And in fact, I had somebody ask me. This was like a week or so ago. They said, "Tom, I can't sleep at night. I've got too much money on XYZ. What do I do?" And I said, "Well, sell down XYZ until you can't sleep."
Right.
That's the definition of chaos, folks, is doing the same thing over and over again and expecting a different result. And
Yep.
so, we want to talk about, how we are rules-based traders. We'll talk about, creating alternatives out there. But more importantly, it's about planning, executing, managing, and walking away from the screen, right? Now, in some businesses, walking away from the screen is that equals losses for their business. But for us, walking away from the screen is a good thing. I mean, here we are. This is the second day of August. Chris and I are looking at a broad sell-off in the market. You take a look at the news that's out there. And Chris, what's the number one thing? You and I just talked about this before we went live. What's the number one thing that's out there that's on people's minds that's being talked about as we head into the first week of August?
Today, right now, August 2nd, you mentioned not sleeping, and I made a joke about it earlier. Janet Yellen maybe lost a little sleep last night because Fitch has downgraded the U.S. debt. They've
Yep.
come out and downgraded us to AA plus. Ironically, the same place where S&P is. They downgraded us in 2011, Tom, back in August 5th of 2011,
Yeah.
and they never took us back to AAA. So Fitch just brought us back down, and everybody's, not freaking out, but they're certainly looking at this from the perspective of the glass is half full. A lot of those, I don't want to call it fear mongering, but certainly this is the end type of headlines that are out there. When in fact, this is something that I think that we're just going to deal with, and the market will provide an opportunity. What do you think about this? This is big news.
My honest opinion is I'm amazed they didn't do it sooner, because all that free money we gave away
Right.
back in not so much 2020. I think the money that the stimulus in 2020 was kind of needed, but market was already rip roaring back, and yet we just piled on more money after more free money after. Hey, by the way, forget about the free money. Let's push what you owe as a student loan out to infinity. Let's kick that can down the road so your children can figure out a way to pay for it. What's the latest thing now? We've tried to cancel student debt. That didn't happen. I mean, it was really more talking points for one side of the aisle. But we knew that wasn't going to happen. But now, more recently, now You don't have to pay them back now, Chris. If you owe money, no, it's okay. You can skip payments all the way until September 2024 now is the new push. You know, they're calling it the on-ramp.
Yes, correct.
That's an on-ramp if you want to continue to escalate your debt. But, for folks that are out there that are grappling with this idea of, should I pay my student debt off, or can I bank on the government taking care of it for me? Listen, folks, don't bank on the government doing anything for you except taking money out of your pockets, and that will happen. There's that. The Fed hiked rates last week too.
Correct.
And so, I want to talk a little bit about that. But and then how about the seasonality? Now let's go into an area that I do know a little bit about, and that's the seasonality for August. And we were mentioning this. Actually, I was on a live stream yesterday mentioning this. So August is I call it a 5-week month, Chris, because you got this week, then you got week 2, which ends on the 11th. You got week 3, week 3 is a big week for option traders that trade week 3 options. I'm a week 3 option trader. And then you got week 4, which is the 25th. But wait a second. We have another week that ends on Thursday on the 31st. So August is it's a long month.
Right.
It's a long trading month. There are 23 days. If you take an average of 20 days, there's 23 days in a month. So we're over the average. Of those 23 days, I can count them. I'm looking at them again right now, that had high bullish days of seasonality. And I'm talking about high is anything in my mind over 70%. There are only 5 days in the month of a 23 month. We have over 70%. In fact, if you look at the bearish months, if you were to look at my calendar, and I have a calendar and I have stocks on it that have repeatedly gone up and or repeatedly gone down, 90% of the time going back at least 10 years, those that qualify for that, we spit them out on a calendar, and it gets more green if there's more bullish than bearish, and it gets more red if there's bearish than bullish. There are more brown bearish days than there are bullish. My calendar looks like autumn is starting early.
The leaves are coming early.
Yeah, we start fall September 21st or something like that. It's coming a month. It's coming 6 weeks early to the market. So when I look at this and we add all this stuff up, now this is me as a rules-based trader, but rules-based trading, we don't look at things like what Fitch says or what an opinion might be. In fact, most of the opinions that you see on mainstream media, when someone's giving an opinion or an outlook on a stock, you notice how, well, Chris, you know this, nobody who is a reporter or an anchor on a financial news organization, at least a legitimate one, is allowed to even own any stock.
Right.
Their parent companies forbid them from doing that.
Correct.
Brokerage firms, a lot of big brokerage firms are the same way. They don't want to get into a situation. I call it being the Dan Dorfman situation. Remember Dan Dorfman? USA Today.
I do, absolutely.
He was putting out his stock trade a day. People didn't realize he was giving a stock trade a day to his buddy a day early.
Right.
And no one knew about it, but then him and the buddy got greedy. And the buddy said, if you don't give me more money, I'm going to go public. And so, greed kills everything, not just legitimate projects, but illegitimate ones as well. And so we call that doing a Dorfman, and no one wants to do a Dorfman, so they forbid these people that are on mainstream media and big, large brokerage firms from owning any stock. So all they can do is own their parent company stock, a 401k, an IRA, or they can own indices like SPY, QQQ,
right, mutual funds, etc. Correct.
So I say that because it's interesting that a lot of analysts are allowed to, but they have to be transparent. And so when an analyst, I find it really ironic when an analyst puts a buy up, somebody's talking about, buy Amazon, but yet then they have that little transparency window right up here by their face. And it says, do you own it? No. Does your family own it? No. Does your dog own it? No. Does your neighbor own it? No. Does anybody own it? No. I find that quite ironic that people will get out there and they will push a stock that they themselves have no skin in.
It's funny you mention that, Tom, because as you know, I used to do CNBC interviews almost weekly. And when they started telling me I needed to give disclosure, because it was always assumed that you didn't own something, but then you had some malfeasance, whatever you want to call it, back in the early 2000s. You mentioned Dorfman there. When you had these situations, all of a sudden CNBC said, and it was NBC Universal, now it's Comcast, NBC Universal, etc. But they said, hey, we want to know if you own it or not. And on more than one occasion, when I would send the producer something and say, here's my stocks we can talk about, and here's my ownership disclosure on them, they would come back and say, we don't want you to talk about this. We don't want you to talk about that. And I said, where's if I'm going to talk about something, I think it should be comforting for people to know that I own it. If I'm
Absolutely.
recommending that somebody buys it, why shouldn't I own it? So there's a put your money where your mouth is aspect that's been lost there. And
Yeah.
it's interesting. There's also another aspect of the media, and I don't think we meant to go off on a media tangent here, but if you look at Bloomberg, the cover of Bloomberg over the weekend, they had this big, beautiful cover of Mickey Mouse with gold and, all the sparkly stars from Disney. And the article was telling you this is why you should buy Disney. Now, of course, Disney comes out with earnings next week. Disney is one of those few companies that is still in a bear market trend. They're still below their 50-day. They're still well below their 20-month moving average. And you and I are pretty well steeped in that contrarian view of the market. And I've always had a little yellow light that goes off when I see somebody from the media that's supposed to be reporting the news and telling us about what's happened with Disney and the setup and maybe the fundamentals, coming out and saying outright, buy this stock right now.
Here's full transparency, Chris. My wife owns some Disney stock.
Okay, there you go.
She's owned it since it was much, much higher. And I say, what are you doing with this crap? But I mean, and like you said, the time to own Disney is when everybody finally decides they've had enough and the pain is too much.
That's exactly right.
And what we're talking about, folks, is we're talking about long-term investing. We're not talking about trading here. We're talking about long-term investing. That's what this podcast is about. So when you look at Fed hikes and you look at Fitch downgrades and you look at the seasonality index for August, and August is just kind of the beginning. I see, and we'll talk about September when September comes around. We'll talk about October when October comes around. But August kind of it comes down. We get a little bit of a bump in September, but then mid-September to mid-October, you get that another leg down. So if you're hanging on the cash right now, you're thinking to yourself, well, if everybody's outright bearish, when's the best time to buy? Well, everybody's not outright bearish right now. There's still a lot of folks that are going to buy the dips. And so, we look for, if I'm looking at my shopping list, if I'm going to Publix, for instance, and we do this, go to Publix, the best day to shop at Publix is, Chris?
Thursday.
Yes.
Is it really?
How did you know that?
I'm just figuring nobody's out there buying stuff for the weekend. Friday and Saturday have to be the busiest. And Monday, everybody's kind of doing that reset. And I've got to restock after the weekend. So that was a wild guess on Thursday.
That's great. But I'm going to tell you one more reason, because that's when all the BOGOs come out.
Oh,
all the buy one, get ones come out. And it might not just be for Publix. All the chains might have figured this out. But all the BOGOs come out, all the fresh ones come out. You get the first pick of the litter, and and the thing is that you and I don't have to do this. I do this more as a game than anything else, because I've been pre-programmed to do this for years.
Right?
Why buy something for $10 when you can get it for $5?
Right.
And you got to think about that too, folks. If you're going to go shopping in the stock market, we're waiting for those BOGO offers. And we have different ways of doing that. We'll talk about those on future podcasts. But if you're thinking long-term investor, how can I find the BOGOs? One of the ways of finding the BOGOs is when everybody else can't stand the stock anymore. And even when you start hearing negative news on it, when it stops going down, that might be the time to buy it. I'm going to give you an example right now. I'm not putting any charts on the screen.
I've got one too.
Example. And
I hope you don't take mine.
I'll tell you what, you give me yours first.
Are you ready?
Yes.
Mine is Intel.
Okay.
Intel.
I own Intel.
Ticker symbol INTC. This is the most hated company in the semiconductor sector, Tom. We've been hearing for the last year, and I'm in Ohio, as you know. So right up the road in Columbus is where they're trying to break ground for this new factory. Intel is that company that I think of Intel as like GE. If you look at GE last year, it was hated by everybody. The analysts didn't want to touch it. Investors didn't want to touch it. And they finally figured out, hey, you know what? We're going to get back to our roots with GE. We're going to spin off the healthcare. And if you look at GE stock, it has gone through the roof because they figured out we're going to get back to our core. Everybody hated it. Intel was the same way. Intel was the giant back in 1998. It was the company that enabled the dot-com bubble because we had this brand new technology of semiconductors that they absolutely just hit the metal exactly right on the anvil. It enabled the 2000 and all of that, that productivity that came up. Now they've been sleeping around while NVIDIA's got all the attention. AMD's got all the attention. But last week they came out and gave their first surprise in terms of upside after 2 quarters of missing the expectations on the revenue and the earnings. And everybody has been sitting on the sidelines going, that's a dog with fleas. The old Wall Street term. That's a dog with fleas, buddy.
Now they've pulled back. They've pulled back a little bit here in the last couple of days because, I mean, I think that they ran up a little too far too fast.
9%, right.
But I mean, sitting in this area right now, 30, 34, 35, I think is a good place, for long-term growth for Intel because you just go back to March. This thing was down below $25 a share. It was unbelievable. Everybody was throwing it out then. I own it in the 20s, and I plan on hanging on to it for a long, long time because I'm like you. These guys they're already figuring it out. It's still, and I think it's still hated. And I think you're going to need more than 1 quarter. But
I do. And you know what? That long view, Tom, that we talk about, because we're talking about trends here and long-term trends, Intel, if it gets just a little bit higher, above $35, it'll break above its 20-month moving average. That's the line of demarcation I use to say a stock is in a technical bear bull market. If it does that, that'll be the first time that it's broken above that line since 2013. So if you look at, and this obviously we can go through the past performance, doesn't indicate what the future performance, but if you look at that, Intel went on a rip for 75 months and returned 183% before it topped out in 2019 and really became one of the dogs of the semiconductor. If this dog is ready to run and it breaks into that long-term bullish trend, it is a true opportunity for the people who are going, I don't want to time a stock. I just want to buy it and hold on to it and maybe leverage it a little bit. That's mine. What's yours? I've taken a couple minutes.
All right. This was going to be a controversial one. CJ, because I'm going to say it, and a lot of people are going to think I'm crazy. Budweiser.
I agree.
I'm going to tell you why. Look at the charts. A true technician knows that everything they need to know about a stock is built into its price. So if you were to look back in May when all the problems started, this is a stock that went from $67 a share down to $53.
Yep.
It's beer, folks. And first of all, Bud Light represents a single digit part of their revenue, which means about 92 to 94% of Anheuser-Busch is in somewhere else in beverages. So just knowing that, if you take, if you were to say, all right, well, let's just say Bud Light represented 8%. I mean, which I think is a high number, but 8%. All right, well then, why did the stock drop more than 5 points off of 66?
Right.
5 points off of 66 would have put it at 61. This thing dropped all the way down to 53. And it was because they thought the contagion was going to be more than just Bud Light. But when you walk around the store shelves, everything else that Anheuser-Busch has still selling. And oh, by the way, Bud Light is not sitting on the floor in a lot of these places like you're being told. Bud Light was not 80% off or whatever they were trying to sell it for. It's selling for the same price as regular Budweiser and everything else that they own. And yeah, okay, maybe Modelo is now the number one beer in America. I don't think that's going to last very long. I think that was one
Uh,
side of the the more of the conservative talk shows really kind of pushing that narrative. And when you're a trader, folks, when you're a trader investor, you have to think with independent eyes. You can't get caught up in this left wing, right wing way of thinking. You have to think like an independent. You have to think like a rules based trader. So when you go too far right or too far left, you get emotional. You go right down the middle. You try to stay as unemotional as possible. I'm looking at Budweiser. So Budweiser has Anheuser-Busch, excuse me, has jumped off that low at 53. It came up. It's hit some double resistance up around 59, Chris. Where's it trading right now? 56 and change. I mean,
it's
long term,
27. Yeah.
if you just look at mean reverting averages, this thing should be in the 60s. And so, that's one way of looking at it. Also, here's another thought too. If you are really concerned that we're going to see a potential pullback in the market, you know what stocks perform best when the market goes down?
Beer.
Yeah, sin stocks.
Sin stocks.
Exactly. Yeah. Tobacco, alcohol, firearm, defense stocks, etc. And this one clearly sits in that category. So there's our two long game. There's two long game positions that you could be looking at right there. So but you and I kind of got off the train for a moment. But the thing is that when you look at Fed hikes, you look at downgrades, you look at seasonality. Is this the end of the world? Because a lot of people are getting anxious right now.
No. Tom, I'm gonna opine for a second here, and I'll go a little bit data because I'm the data nerd, right? We just saw a point last week where 90% of the S&P 500 companies, so they're actually 502 when you include those Class C shares, but 90% were trading above their 50-day moving average. Now, if you don't know what that is, people don't know what that is. That's that trend line that says the trend is your friend. The 50-day is. That's it. It gets as simple as that. Everybody's heard that saying, the trend is your friend. Well, look at the 50-day of any stock. That's the trend. So 90% were above that 50-day, that measure. Now, that's great, and it sounds good because it means almost everybody has a friendly trend, right? But the problem is that the market, as we've heard, and I'm not going to bring up irrational exuberance, the old Alan Greenspan, but that idea of a market that just gets a little bit ahead of itself, ahead of its skis, or it's frothy. Whenever we hit 90%, Tom, that's when the market needs a little bit of a reset. A healthy correction is what I call it. It's 5 to 10%. Seasonally, we're lined up for that with September. You've already mentioned that. Also, if you look at it, that extended level of the S&P 500 said, hey, we just need a little bit of a break. There's so many people piled up waiting to buy the dip a little bit here, and they don't want to be that buy high, sell low. So in my opinion, we got through the Fed last week and the market said, let's go, because Jerome Powell basically said, hey, we might actually stick this soft landing. Now you've got the downgrade by Fitch. It allows us to have a reason, a trigger for that healthy correction. And at some point, you got to remember, we're getting through earnings season right now, which has been going well. 80% of the S&P 500 companies have beat their expectations.
Shocking, huh?
Yeah.
Shocking. Because at the beginning of earnings season, that wasn't the case. Everyone thought this was going to be the cliff.
Expectations are low. I just was reading this report from Third Point, Dan Loeb, talking about how hedge funds that have been trying to short individual stocks for the last 6 months have started to throw in the towel over the last 2 weeks because they have to go long. I think everything lines up for a healthy correction that, as you described very well, and when you look at your money calendar, it's going to say the same thing. We get opportunities that build from that. I think it sets us up for one heck of a last quarter of 2023. I mean, where everybody's trying to run to get on the bus.
Yeah. I mean, so you know what? I think the other thing that we probably want to talk about before we get too close to the timeout,
right?
Is this is the other big news story that everyone's talking. I mean, this is what's being talked around the I call it the remote water cooler, because so many people work from home now. So, I have a water cooler. I have two actually. So, you know, they say that one of the biggest unnecessary expenses that you can have is buying bottled water. But
Yeah.
but I have to say, you know, the other alternative is, the stuff that's running from the well in Florida.
Yeah.
It's a little smelly. It's
It
very
does have
sulfury
that
smell. So
odor. Yeah.
kind of
Yeah.
have
I'm
to buy
familiar.
that. But
Yeah.
yeah, I have one upstairs and one downstairs. Anyway, where was I going? So here's the thing: what's being talked about around the water cooler now? Interest rates, and the fact that now there's actually that companies, banks, not so much banks, but brokers are
Mhm.
now paying you a fairly decent amount to hold on to cash. So, besides the opportunities that we see, like if I were looking at long term opportunities, regardless of where the market goes, I think there are long term opportunities in Bitcoin. I think there are long term opportunities in gold. And we'll get to those. We'll talk about those in the coming weeks. But
Yep.
the one opportunity that a lot of people are talking about that they don't have to really do anything with is the US dollar. And so I can go nowhere easier than Robinhood when we talk about this. So Fed raised rates last week, the 5.25, 5.5 target. Robinhood comes out immediately, and their rate that they're paying on uninvested cash is now 4.9%.
Mm.
They are so they are the highest. And I just did a video on this, Chris. And in the video, I talked about the Fed, I talked about Robinhood's rate, and I also talked about why you and I will never see 4.9%. And the reason why, well, I mean, we can get close, but most people are not going to be able to get that 4.9%. I'll tell you why. Because let's do some math here, folks. 4.9%. Now, let's say that you have $10,000 that you want to put somewhere, and you think you're going to put it in Robinhood, you're going to get that 4.9%. The problem is you're not going to get 4.9. You'll get close, but here's the thing: in order to get the 4.9% Robinhood, you got to be a Robinhood Gold member. Robinhood
Mhm.
Gold membership costs $5 a month. So $5 a month means that, first of all, you got to have at least $1,225 in that account just to break even, because you'll make $5 a month on 1225, but you'll be spending $5 a month on
Right.
Robinhood Gold to make the 1225.
Right.
So what do you get in $10,000? You get $490 in a year. That's 4.9% on 10,000. But wait, you got to pay $60 to get the 490. So you really get 430, which is
Right.
4.3. So there are other brokers out there that pay a high rate. Interactive Broker, I think, is paying 4.83% as of today. But you don't need those guys, folks. With a little bit of education and just about that much knowledge, you can find out very quickly that there are products out there that you can buy, that you could take any stock, any equity account can do this. There are ETFs out there. Bill is an ETF. SGov. I am invested in SGov. I don't have 100% of my money in the options market, Chris. I
Oh,
don't believe you
no.
do either. That would be
No.
just plain stupid.
No. No.
I mean,
No.
me
What did
telling
we
you that I have $100, or that I have 100% of my money trading in options, that'd be about as dumb as, I heard this before, a wood shop teacher teaching you how to use a table saw when he doesn't have any fingers.
nubs, all nubs.
You don't want that. You don't want that kind of so for me, I have a small part of my portfolio in options. I have a
Right.
much larger part of my portfolio in long-term investments, both public and private. And more recently, I mean, since the Fed is raising rates, and remember, you go where you as an investor, you want to go where you can make a decent return. And you know what? I can get 5.25%, almost 5.25%. I can get 5.2% buying SGov and just hanging
Yeah.
on to it. It's an ETF that tracks the 0 to 3 month treasury bonds. And so it pays you monthly. I think it pays 44 cents, 44 cents a month. It's a $100 instrument, Chris. That $100.20, I think, is what it is. Pays 44 cents a month. So if you've got $10,000 into that, you get, and you're getting that 44 cents a month per $100 investment. That adds up. It
Yeah,
adds up to, I think, 5.2%. And I didn't need to go gold. I didn't need to pay the, so for people that have a couple of $1,000, and they realize, wow, if I have $2,500 and I do the Robinhood $5 gold, I'm only going to get 2.45% for my
yield
money.
netting, right?
Double that by
Right.
doing nothing. Because what we're talking about is doing nothing. It's uninvested cash.
Right.
Cash is a position, especially if you can earn a return from it. So why not earn a return? If you plan on staying in cash, why not go in and buy the S-Govs or the bills and get the 5.2 or 5.3% return while it lasts? Because it won't.
Yep.
Folks, it's not going to last. And you know what? This time next year, the interest rate may be a little bit less. We don't know.
Well, this time next year, it should be. I mean, if you look at the forecast right now for the Fed, sometime in May or maybe April or March, I think it is, they're forecasting, the bond market's forecasting that we'll see the Fed start to pull things back. You know what, Tom? Not to go off base here for a second, but a lot of people think they want the Fed to start dropping rates this year, like at the end of the year.
Yeah.
And I think people need to understand that if that happens, the only way that happens is if Jerome Powell and the other voting members of the Fed see something that is very, very worrisome. And they have to now start to stimulate the economy. They've been tightening. They've been putting the leash on the economy, trying to pull it back because inflation was out of control.
Yeah.
So if they let that dog off of the leash, to use that analogy, it means that something has gone incredibly wrong between now and the end of 2023. So believe it or not, people, you want these rates to be level for a little while.
You do.
Yeah.
But you know what? I honestly think that the rate hikes, this all could have been avoided. This was not inflation like you and I typically see normal inflation. This was caused, this is my opinion, but this was caused because of supply chain issues.
Yep.
And it was caused because of COVID, because all of a sudden, everybody, unless you were a hospital worker, you were pretty much unnecessary.
Right.
And if you're unnecessary, stay home. Don't give everybody the disease that was, in my opinion, not much different than the flu. Right. Maybe a little worse. Yeah. But we put millions and millions of people on the sidelines. All of a sudden they're staying home because they're not necessary, and that led to less products being bought. And of course, that between that and what's going on in China, a lot of the problems, the products we thought were going to be shipped over here, they weren't happening because the Chinese were not working either. Nobody was working. Right. And so what happened? It led to higher prices in products, led to, with less people working. And not even just in the product industry, but in the service industry too. I mean, I've kind of stopped going out to eat so much for three reasons. Number one, it's kind of unhealthy because you don't know what kind of grease they're cooking this stuff in. Number two, you've got the service is just, it sucks. Right. Because there's less people there. And I'm not talking, I'm not dogging the people that are working. God bless you if you are working, because you're working twice as hard because there's not enough help in some of these places to dine out. And number three, and this is my pet peeve, I've stopped going out even picking up food, because now I just feel like I got to tip everybody.
Oh, I mean, my gosh.
You go pick up something, a pizza. I throw a couple dollars down for picking up my own pizza that you've been cooking for decades now. But now they flip that little screen around, and I feel like I'm forced to give a 20% tip.
Tipflation.
Twice as much as it did last year.
It's called tipflation. That's what they're referring to it now. And the owner of Shake Shack, or the guy that started Shake Shack, actually said, Tom, you can feel better with this. You are not required to tip somebody if they're not providing a service. If you're just picking up, if I'm running a Domino's and picking up my own pizza versus having somebody drop it on my door, I'm going to pay myself a tip at that point.
Exactly.
I'm doing the work. I'm providing the service. So
Exactly.
you can feel better about not tipping, Tom.
I mean, it's kind of like, it's kind of like too, if I'm going to like a Subway or a
Right.
sub shop in general, and I'm picking out my bread and I'm picking out my meat and I'm picking out my cheese and all the other stuff, and then they hand me an empty cup, and then I got to go fill up my own Coke. I mean, if
tips
I'm
and
not providing, I don't feel like tipping somebody if they're going to make me do part of the work. Go to the salad bar, go this, do that. I mean, it is. It's gotten out of control. Okay, so I've gotten a little out of control here, but where I'm going with this, folks, is that if you look at cash as a position, cash is a position. And right now, cash is a position where you can get in excess of 5%. It's not going to last. Chris and I both know it, so grab it while you can. As far as other long-term opportunities, we're going to talk about them. But I think I want to end the program talking about all this anxiety that has been happening. It started out with sell in May, which never happened. And then sell in May became, oh, wait a minute, July. It's those Q2 earnings. Those are going to cook us. Sell in May is now sell in July. July was one of the best months on record.
3.6% on the NASDAQ 100.
And that's with increases in interest rates. Go figure. Yep. So, couple steps that I think that people should take to kind of look at your account with less anxiety. Number one, stop looking at it every day. That's I look at every time I open the Robinhood account up, it pops up where it pops down, and that line, I'm like, oh my God, the line is up. Wow, I'm making a ton of money, and I look and it's like 0.002%.
Right,
but the line's like this, so it causes you to jolt. And the line, like today, the line's down because everything's down. And I'm looking at the line, I'm like, this is nothing. I'm down 0.03%, not 3%, 0.03%.
Right.
Nothing. So stop looking at your daily account unless you've got to put a target price in or put a stop price in, or you're actually doing some active management. And step two is when you put your orders in, whether they're long-term or short-term, plan, execute, manage, and then walk away.
Yeah. Go mow your grass.
Yeah.
Go do something with your family. Go live a life.
Exactly. Yeah. And in fact, what I do is when, with me too, I mean, I've turned more and more. I think with every piece of technology, there's something good that comes along, and there's something that's bad that comes along. And with technology, the fact that I have everything I need at my fingertips is great, and then it also sucks.
Yep.
And so how do you take the great, and then you leave the suckiness of technology out? Turn off all your notifications. That's a big way to do it. Get rid of the notifications. I don't need to be notified every time Trump gets indicted.
Nope.
I don't need to be notified every time a stock I have in my portfolio is up or is down. All it does is it for me, it takes me off my daily focus of what I need to be thinking about that day, which in a lot of cases is, not the stock market. So.
Go back to that comment and the pandemic and 0 day to expiration and all these things that we've said. The stock market got turned into a daily, for some people, a daily lottery machine, like those scratch offs. It got turned into something that was an online, a DraftKings. A lot of people looked at that when they were holed up in their house and said, well, what am I going to do? I'm not going to be working, or I'm not going to be doing this. Well, I can sit here and pull up my Robinhood and start trading all these options. And you hear endless stories about people who traded on margin and then lost more because they didn't know what they were doing with the margin account, or all of these things. And every once in a while, you just need to slow things down and get back to living. Tom, it's funny. I think we've talked about it before. I've got a boat, and everybody comes down and they get on the boat, and in the boat is a waterproof kind of a thing that I bought at Bass Pro Shop of all places. It latches and it's got a combination lock on it, totally sealed. And the rule is, if you're on the boat, your phone goes in the box and it gets sealed and up under the dash.
Nice.
So everybody can sit and talk like you and I now, and not have to look every minute at who's texting me. Like you said, who's getting indicted, what stock is doing what, blah. you've got hundreds of thousands of things that can distract you from that one thing that's most important, which is just kind of experiencing your life.
Yeah.
Don't
Yeah.
let
Absolutely.
investing be one of them.
Absolutely.
Let it help your life. Let it, move you forward, but
Yep.
don't let it rule it.
Yeah. So, as we end this podcast, I want to let everybody know that our podcast is, it's a mix of things. It's a mix of what's going on in the markets and what to look at and what to avoid.
Yep.
It's also going to be a mix of longer term opportunities that Chris and I see. But you know what? This is also a confessional for Chris and I to come in
Yep.
and talk about not only what we're doing right, but what we're doing wrong. And so, as I look at the month of July, to me, what I did right, I got to say, is I positioned myself well ahead of the big move in Intel. That was a definite long-term good move for me. What did I do wrong? I got to tell you, I added into my Tesla position, and I added into my Tesla position just south of 300. And here we are sitting now in the 250s. Now, that's not exactly a bad thing because I plan on hanging on to it for a long time. But I got caught up in a lot of the Elon Musk, the muskiness, as I like to call it.
The
And so
daily
I
feed.
added to a position that I felt like maybe it was not the right time to add. So we all got to get caught up in it, but it was a good. Did it hurt me? No, it didn't. It hurt me about that much, and it really hurt me here more than anything else because I never, I never invest too much into one area, and that's probably, kind of our walk away points, folks. Are number one, if you're going to play the long game, you got to think about the long game, and that means don't look at some of the day-to-day minutia that's out there in the world. Number two, don't bet more than you can sleep with at night.
Right.
And of course, number three is just have that long-term plan. That's really it. Any final thoughts here, Chris, before we cut it?
I'm gonna give my what I did right. I started to look at the financials again, Tom. We talked about expectations of Intel. We came off of last quarter, and everybody thought that not one but multiple banks were going to fail. After we saw what happened, the carnage that happened with Silicon Valley and Signature, all these companies, these banks. So I finally opened up and said, you know what? They're not all going to fail. And as a result, I found another one of those most hated trades. What did I do wrong? You know what? I still tried to fight the battle, the one that I talked about, with Third Point. I still tried to fight the Fed a little bit here. And the trend is my friend right now. I mean, the 50-day moving average is moving higher on everything. And I think that refresh of saying, you know what, I got to stop fighting this. It's going to scare me because, I've got calls now and I bought a lot of stock. But at the same point, if I keep in mind the perspective of this short-term pullback that has been triggered, that healthy pullback, I'm just going to find more opportunities. And as all these hedge funds try to load in as we head in towards that last stretch of the year, I think we're going to be positioned to be driving the bus instead of trying to climb on, that little door in the back of the school bus.
Yeah.
Everybody else who's waiting too long is going to be trying to climb through the back door of the bull bus here. And it's better to be somewhere in the middle of the bus, or driving is ideal, obviously.
Yeah.
Yep.
All right. Well, thanks for joining me, Chris. Thank you all for joining us on Power Profit Podcast. And you know what? Next week, I think what we'll do is, Chris, let's talk next week about alternative investments other than the stock market that we see. And I'm really kind of thinking about Bitcoin and gold.
Okay.
So bring some of your best Bitcoin and gold stories with you. I will too. We'll discuss these and why I believe both of these make a lot of sense as being a small part of your portfolio. All right. We'll talk about why on our next podcast. Thanks, everybody. We'll see you.